Another market voice and a big one now. Rick Rieder, he is BlackRock's Chief Investment Officer of Global Fixed Income. Find out where he oversees more than $2 trillion in assets. He's also the head of BlackRock's Global Allocation Team. You have to have so many titles, Rick. I can't even get them all out without stumbling over them.
Sorry for making it hard, Scott. Thanks for having me on.
Give up one or two. It's okay. You're still the bond king, all right?
No, I'm trying to generate return every day.
I hear you. You do a good job of it. Global Allocation Fund, 62% equities versus 25% fixed income. There's really no competition for stocks right now, is there?
No, I mean, you framed it right. I mean, your conversation earlier about free cash flow. We're dying for free cash flow in the fixed income market. And I think, as Richard said, the Fed's not going to let us have any for a while, not just in the Treasury market, but you look at the credit markets. I mean, where companies are funding today is extraordinary. I mean, the free cash flow sits in the equity market. So, we think while equities are not cheap almost by any metric, although I would argue, actually, if you take free cash flow, we use a metric discounted by forward interest rates, by the forward curves and interest rates. It's actually the cheapest it's ever been. Equities by that metric. And if you believe that the Fed's not moving rates, as Chair Powell has said, for 2 to 3 years, equity market, A, has the free cash flow, and B, it is certainly companies can fund themselves at incredibly attractive levels for a long time.
You go as far as to say that the Treasury market right now is uninvestable.
It's other than holding cash. If you think about the five years in, you're getting 33 basis points, and the Fed's not going to go to negative rates. So if you're going to sit in cash, you might as well sit in cash. And I'm not, they're not going, rates aren't going higher. The only part of the yield curve that makes some sense for balance in a portfolio is 7 years and longer. The 10-year Treasury at 72 basis points is not exciting. But and by the way, the long end of the Treasury curve at about 1.5% is not that exciting. But if the economy stumbles, if the Fed has to do more, they will pull down. They will use yield curve control either directly or indirectly. They'll pull those rates down.